And good morning to our listeners and viewers. Welcome to Dollars and Making Sense for the week commencing 11 November. Welcome, Henry.
Hi.
Great to have you back again. Again, thanks so kindly. And just to explain our multimedia format, we do a YouTube channel. We also use the audio from this particular recording on a radio broadcast for community radio on Radio Northern Beaches, which happens to transmit on 88.7 and 90.3 megahertz on the FM band. And we also then extract the audio for a podcast on Whooshka, and part of the radio show also then features potentially some vendor interviews that I do, which is separate to this particular YouTube channel, but you can find that on the radio show and also our podcast. And I'd also like to mention Henry is a well distributed writer. He writes for his own blog, Beaks Down Under, which we featured in the narrative last week. So you can look at that link, and we'll post that again on the YouTube annotations. And you also write for Marcus Today as well, don't you?
That's my main job, yes.
Wonderful, wonderful. Okay, so as you can see, we reuse this format over and over. And again, as always, we welcome comments, feedback on our socials via Facebook, Insta, and our website blogs. So again, let's get stuck in. So last week, we covered off the banks, a lot of talk about the banks, and because we recorded on the Monday, we had speculated there wouldn't be any movement in the interest rate on Melbourne Cup Day, and I don't think anybody got that one wrong, did they?
Nobody got that one wrong, no. No, it was very much as expected that there was no rate cut on Melbourne Cup Day, and probably there won't be one in December, and we'll have to then wait till February to see what happens there.
Right. And again, we also talked about Marcus Padley's article, Penniless at 100.
Yeah.
And again, the thing that I guess I focus on a lot is, because of the clientele that I mainly deal with is being superannuants and retirees, this continuing chase for yield and moving up the asset classes and also the risk curve.
Yeah.
So I think this is going to be a recurring theme, because as we continue to live in a low interest rate world, nobody can really live on 1% returns on their cash, can they?
No, unless you've got a lot of cash to start with, of course.
Yeah, but even then, if you've got a lot of cash, you've got a lot of cash because you weren't silly enough to just get 1% on your money, I guess.
Well, that's true. But, I mean, there's obviously a different phases in your life when you're going through accumulation or when you're looking at growth, and then you're looking at income later in life.
Absolutely, absolutely. And again, listeners and viewers, what we're going to be doing, we're almost coming up to about a month that we've been doing these now since our launch. And one of the things that I'm going to be doing via our email campaigns to raise awareness of this particular YouTube channel and radio podcast is we're going to start now tracking Henry's recommendations. So we're about a month in, and so I'm going to start tracking from the date that Henry gives those recommendations and simply start tracking how those recommendations are going. And obviously, Henry, I want to give you the opportunity so that, let's say in 6 or 8 weeks' time, you review some of those recommendations and say, okay, that one's gone as far as I think it should, and maybe sell up at that particular time. Because I think, you know, the notion that you would give a recommendation in November and it still hold true in February obviously doesn't make sense, does it?
Those days have long gone. The buy, hold, and just keep forever, those days have gone.
Yeah, absolutely. And I think when we're talking about buy, hold, and keep forever, we're going to be talking about that quite a bit more today as well. So let's get stuck into your blog. I took down Thursdays and had a good look through that. And again, listeners, remembering that Henry looks specifically at small caps, okay? And again, can you just review that again, just so that for new listeners, what that means between small caps and, say, the big guys that get reviewed by the bigger houses?
Yeah, I guess small caps is an interesting sector, and it depends what you classify as small caps. Now, I tend to look at stocks under 2 billion, but there are bigger fund managers that will say small caps are under 10 or under 15 or whatever their benchmark is. But I tend to look at stocks under 2 billion, mainly because they're not as well researched, and you can do a lot more of your own research, so you can get a bit of a handle on it without being steered into a certain direction, maybe by a big research house, which may or may not have some conflicts of interest involved in that small cap stock. So that and 2 billion is quite a big stock, really. I mean, I look at stocks that from $5-10 million to 2 billion is where I like to kind of hunt, because those are the kind of stocks, if you get them right, you know, you can get 1, 2, 3, 4, 5 baggers in these things. That's what we call them. If you 3 or 4 times your money, that's 3 or 4 bagger. And those are the sort of things that can really But they can change your life, obviously, if you get them right and you have enough money.
Say a 1,000 bagger like Cisco was back in the day.
Yep, that's certainly something that you can change your life with. But also, it does, if you've got a balanced portfolio, it does give you a little bit of a kick in the tail, and that you can get a little bit of extra performance out of some of the small caps, which overall, although the rest of your portfolio could be highly defensive and income based, maybe, the small caps can give you that little bit of a kick in your performance.
And I guess what I've been asked by a couple of my listeners and viewers in the last few weeks is, why listen to us when they can listen to a whole bunch of other people? And I think that's the key difference that I'm trying to say to people. Look, there are many people that are commenting on the banks and BHP and the big guys, but something that I'm looking forward to is gleaning, some of these hidden gems that you research by not necessarily being where the big guys are.
Yeah, well, that's in the newsletter that I write for Marcus Today. I mean, we do look at the big stocks, and we do look at the little stocks as well. But I tend to look more at the little stocks and overall strategy and macro stuff, because that's just the area that really interests me. And as you say, Ray, there's a lot of people talking about National Bank and BHP and those sorts of things, and there's not many people talking about stocks like Frontier Digital Ventures and those sorts of things, which are fun.
Okay, so let's look at some of the musings that I've picked up during the past week. In your latest blog, you talk about Zip. Now, they've locked in a particularly interesting deal with Amazon. What's been the impact of that?
A pretty good impact so far. The stock price has had a big rally. This was stock has been going down for a little while, as had the whole sector. This is a buy now.
They compete with
later.
Afterpay, don't they?
They compete with. They're in the same space. I don't know if they compete. They are slightly different business models.
Right.
Afterpay is more your $150 kind of purchases, whereas Zip is more a kind of a line of credit, or even maybe slightly bigger purchases, shall we say. So Afterpay really has resonated with the millennials. Zip's been around quite a long time as well, as has FlexiRent, which is
that's been around a long while.
Which has been around. Flexi were the Flexi group who invented FlexiRent, were the kind of the first cab off the rank in the buy now pay later sector, with the offers that used to get in Harvey Norman, 50 weeks interest free, or 50 months.
50 months, I think.
50 months interest free, or 20 months.
4.5 years.
Whatever it was.
Yeah.
So it's been around a while, but Afterpay made it trendy for millennials, and it was high turnover, 4 payments, etc. Everyone kind of knows the story. Zip have done a deal with Amazon.com.au, so it's the Australian Amazon.
The local branch only.
It's the local branch only. Zip hasn't had the sex appeal that Afterpay has got, because Zip has previously only been local,
right?
No international. Whereas Afterpay developed their model here, and have now taken it to the US, which is obviously a massive market, and the UK as well, which again is a massive market. But being massive markets, that also brings competition. So Zip has stuck to their knitting here and have just done a deal with Amazon for the Amazon Australia business here, where they are the preferred provider of buy now pay later services on their website. So that kicked off last week, and that really arrested their decline, because the stock price had been falling quite substantially over the last month or so, as had Afterpay. So that turned the thing around. I think they were up 17% on the news, and up again on Friday. So good news there. And I guess it's twofold. One, it drives business to the Zip platform, which is always good, because that's how they make money, is getting more and more punters buying stuff through their platform. Mm-hmm. But also it gives Amazon a kind of a try before you buy kind of option. They can see how Zip is working for them in Australia, and then if they say, well, hey, this is really good,
so it's like a bridgehead market, then
we could roll this out to New Zealand, we could roll it out to Asia, we could roll it out to the UK, we could roll it out to the US. So it gives a lot of optionality, I think, for Amazon. Of course, there's always the chance they say, hey, this is so good, we'll just buy the company.
But again, if you're a shareholder, you won't balk at that either, will you?
No. Well,
as long as the premium's right.
Yeah, as long as the premium's right. I guess it comes down to are they getting it at the right price? But it does give Zip a big tick in the box, because Afterpay didn't get the gig. So Zip has really sort of kicked some goals this one. And as I say, it is kind of a bit of a try before you buy for Amazon. be interested to see how it goes. So, we've all had various different opinions about how Amazon Australia has been going. It was announced that, when it came here, it was massive fanfare. It was going to destroy retailing, etc. It hasn't had that impact. I've bought a few things on it, and it's good, but the prices aren't dramatically.
They're not spectacular.
They're not spectacular. I mean, if you want 400 dishwasher tablets, maybe maybe that's great. But who wants that sort of supply?
Yeah, I think certainly, and again, it's a very personal thing. So the anecdote, rather than a wider market research, validation. But for mine, I just sat there and went, yeah, I've bought from Amazon, but the kit that I want, I end up having to buy from the American website anyway. So anyway, that's neither here nor there. Again, I think it's good for Zip. And the other highlight that I saw was one of the wax stocks, Xero.
Yeah, Xero is a funny one. It's an accounting software business, and it finally, I think, made a tiny weeny just about profit, or at least a very small loss, which was a real good thing for them. And this stock has gone nuts, I have to say. It's highly priced, and it has gone pretty much nuts. And it's another one of these stories which has been a proven formula in Australia and New Zealand in terms of this accounting software.
They started in New Zealand, though, didn't they?
They did. Yeah. And have now they're now trying to take on the globe. They're trying to take on the US, which of course is the big market. That is still, I think, elusive for my money. I think they've still got a lot of work to do there, but the market seems to like this stock. They like the whole viral nature of this software package, in that once you've got it, it's kind of hard to get out of it and go back to Quicken or whatever.
And again, in previous broadcasts, viewers and listeners, I've very openly, shown my conflict of interest. I'm a user, but I'm also a convert from the old MYOB, and I got to tell you, it would take wild horses to drag me back to the old way. I'm a big winner.
Yeah.
I'm a big convert on the Xero way, doing it in the cloud. And when I look, for example, in the contacts, and I think they've got presence now in the United States, UK, South Africa, New Zealand and Australia, and I, just from a pure technology perspective, not management and operating profits, but just from a pure technology perspective, I just see them going leaps and bounds. The functionality is fabulous.
Well, and the good thing is that once you have got the system, as Ray has been talking about, you become an advocate, you become a big promoter of Xero, and so you're doing their sales for them, which is good. So it does have that viral nature where you get it, you're happy with it, you tell your friends, hey, you got to get on this, and once you're on it, it's sticky. People don't change software packages that often. And
again, I think there's a real abject lesson there. For those of you that may or may not know about Atlassian is well known amongst tech heads. Okay, but Atlassian is a company that doesn't have a sales force. They've only ever relied on engineers and word of mouth. And so there is another company that's gone from strength to strength purely by word of mouth. And it's well known, Mike Cannon-Brookes and Scott Farquhar, the richest young dudes in this town, big time. Right? They're worth about $8 billion a piece these days. And they're buying up all the real estate on the East Coast, and good luck to them.
Yep.
But for mine, and I've got some mates that work there, they love the software, and again, it's this viral nature of people loving this product. And I think, again, when you're choosing what to invest in or what not to invest in, I think that very personal experience becomes a factor. If you like the product and you're sitting there going, well, God, I'm buying it, I think that's a really great indicator of, maybe other people are buying it, maybe I should be investing in it.
Well, you've got to use it. I mean, if you're thinking of investing in Afterpay, do a transaction through Afterpay, see how it works, get a feel for how easy or how hard it is. Same with Zip. I've used Afterpay and I've used Zip, and Afterpay, simple as, absolutely a very simple procedure.
It's a snap, isn't it, at the point of sale?
Zip is a far more painful experience, of far more boxes to tick, things to do. But then again, you're asking for more money, perhaps. Mm-hmm. So maybe there are some checks there, but you should do research with the Mark I eyeball, because it is a very useful tool, and get experience of the things you're investing in. If you like Xero and you like the products and you're a convert, buy the stock.
And again, it's an interesting thing. I always remember this wonderful presentation by Magellan, who do international stocks, and their spokesman, a lovely lady, simply gets up there and says, guys, if you buy their products, if you eat the chocolate from Nestle and like it, well then, you should be investing in it. And again, they're sage words. I mean, it's the simplicity of the message that I love. If you like the product and you're buying it, then there's a bunch of other people doing the same thing.
And if you're in a younger generation, I mean, it's up to the younger generation to spot the next Facebook, to spot the next Google, to spot the next Apple. Because these businesses weren't around 20 years ago. They may not be around in another 20 years. Something else might come along that you're using now, and you go, hey, this is so much better than Facebook. Let's use this instead.
Well, I think as many people keep on saying that the demise of Facebook is just around the corner, I'll wait and see. There's much to happen.
I've got to say that people keep writing them off, but they keep making an awful lot more money than anybody else.
They certainly do. So, moving on. Last week we did a lot of discussion around the Big Four and the results.
Sorry.
Do you need to?
I'm going to sneeze, but keep going.
That's okay. We'll keep going. Okay, so again, and I'm picking up now as you were talking about it, the flow through the trade press started happening, and again I picked up this good one, Macquarie smashing the Big Four, and so again, viewers and listeners, many people out there are holding the banks, and for good reason. We talked about dividends and the franking credits last week, but some really sobering numbers around Macquarie. Please explain.
A lot of people do hold the banks. I mean, Macquarie is the fifth part of that banking group.
Not Bendigo Bank as they keep advertising, right?
Well,
we talked about them previously as well.
Not really. I mean, Bendigo and Adelaide and Bank of Queensland. I mean, yes, they are. They're regional banks. Macquarie is a truly global entity because it has massive businesses in the UK, the US, and in Asia as well, and of course in Australia. It's not in the same kind of ballpark to some extent as the Big Four because it doesn't have branches, it doesn't have that high street presence, it doesn't do so much in terms of retail banking, but it is pushing ahead dramatically in terms of the mortgage market, in terms of that personal home loans, and they have done a really, really good job. It is inherently more risky, Macquarie Group or Macquarie Bank. It is a more risky entity because it engages in activities that the banks really don't engage in. They're a lot more invested in the capital markets, and a lot more invested in commodities, currencies, these sorts of things. So it's got a lot of gearing to the economy and also to the stock market and other markets. So it's not the same kind of beast. But what it does do and what it has done is that it's now paying. It makes $2 billion a year in profits.
Wow.
And it's paying good dividends now. The yield on Macquarie, which used to be negligible because it was a growth stock and all the money was being piled back into growing their businesses, now shareholders are getting rewarded. And although the franking, because of the nature of their business being overseas based as well, is only 45% as against some of the other banks here, which are 100%. But when you have Westpac and ANZ cutting dividends, cutting franking, etc., etc.
That's a good point.
Macquarie is starting to, you've got ANZ coming in with a 70% frank dividend. Macquarie's 45%.
And this particular article refers exactly to that. So they refer to ANZ Bank now, where they've reduced their franking from 100 to 70%. Westpac have delivered a 15% cut to its dividend, and NAB a 16% decline in its financial year 19 dividend versus financial year 18. And so and again, the banks have essentially rebased their payout ratios.
Yep.
So that becomes a big factor because those, and we talked a lot about this last week, people that are buying and holding, they don't care about the stock price. But again, the effective yield then becomes a factor of the stock price, doesn't it?
Yeah. The problem that the banks have had is that, apart from the Royal Commission, which obviously they never wanted, is that
was self-inflicted as well.
Self-inflicted to some extent, but like investors around the world have had to move up the risk curve to get better returns, the banks have had to kind of do the same thing as well, and they've got out of a lot of businesses. So the majority of the bank's business now comes from home loans, and as a result, the regulatory authorities, APRA, the RBA, the government, ASIC, whoever is regulating it throughout the world, throughout the country, wants you to hold more capital on your balance sheet. And so for banks to be able to hold more capital on their balance sheet means they either have to raise money, which obviously they have done. Westpac has raised $2.5 billion, which goes straight to the balance sheet.
Which we mentioned last
week. It's not
week.
like they're buying anything. Or they have to not pay as much of the dividends and the profits out as they did before, which is what they're doing. They're rebasing. They're rebasing that those payout ratios, which were always very, very generous, too generous to some extent. So they're now using some of that, taking some of that generosity back and putting that money back on the balance sheet to satisfy the regulatory authorities. So inevitably dividends come down. Now, NAB's came out with a okay-ish result, all things considered. The stock price actually rallied on the back of the result, even though they cut the dividend, mainly because people were relieved that they didn't cut it. They didn't cut it more, didn't have a capital raising.
So it wasn't as bad as what they thought.
It wasn't as bad as it could have been. They didn't cut the franking, and they didn't raise money apart from through a dividend reinvestment plan. So the stock price actually rallied. The whole sector turned round and rallied. And the other thing that we're seeing at the moment is the whole bond market as well changing. That dynamic there has changed dramatically as well. We've had 10-year yields in Australia go from under 1%, 0.95%, 10-year yields to about 1.3%.
Yes, I saw that.
That's a big jump.
That's a big jump in bond.
That's a big jump. And that's not just in Australia. That's around the world. There was 17 trillion US dollars of negatively yielding debt accumulated by investors. It is now down to 12.5 billion.
That's a big change.
So that is a big change, and it's not just because people are taking their money out of those negatively yielding instruments. It's more the fact that the market has rallied, the yields have rallied, so they're no longer negatively yielding.
They're not underwater anymore.
So this is all plays into this global growth theme that if we get a trade deal, that will help things along. So, but it's been a big change in the bond market.
So do you see then, with that in mind, that people should be looking more so at Macquarie as well as the Big Four?
It's a very different risk profile. Macquarie is a geared banking investment. Macquarie is geared to the market.
So it's not the same beast, even though it has bank after the end of the corporate name.
Well, it's called Macquarie Group now rather than Macquarie Bank.
Good point.
It is a very different beast. What they have done, though, is they have de-risked the business over the last decade from your traditional investment bank style operations with mergers and acquisitions, advice, trading businesses. They have de-risked that business by growing the funds management business of Macquarie. And that's not just in traditional funds, but also in infrastructure funds, managing lots and lots of money for investors, and these guys are specialists at infrastructure.
They're good at it.
They are very good at it.
They own Sydney Airport, don't they?
They used to.
They spun that off.
Yeah, that's now.
So maybe articles that are there comparing Macquarie Group to the banks is an unfair comparison. Then we're not really comparing apples with apples, are we?
We're not really comparing apples with apples. Don't forget that during the GFC, there were stories that Macquarie were going to go out of business, and they got down to $16, $17, $18 at one stage. Now, it's not to say that there wasn't any potential for Westpac to go out of business, because in the 90s, Westpac nearly did. They did an issue at $2.50 to stay in business. So, but the risks are, Macquarie is a far more leveraged beast to equity markets and global growth, whereas the big four banks are far more predominantly leveraged to local housing.
Yeah. So again, I think that's a good and worthy discussion to have, because when people write articles that say, Macquarie is monstering the big four banks, it sounds like one bank, really lording it over four other banks. But as you've rightly described, we're not really comparing apples with apples. No. So a good discussion to have. But again, maybe for those that are willing to have something a little bit more risky, that's worth having a look at. It's time.
Here's our disclaimer. Thanks for listening to Dollars and Making Sense, a weekly program about finance, money and investing. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances, and if in doubt, you should contact an authorised licensed financial planner.
Now, very, very quickly, talking about banks and what they're not doing anymore, they pretty well all sold their wealth divisions off, didn't they?
Except Westpac.
But there's been major changes there as well.
There has, but Westpac Westpac have been far more old school than the other three. I think it's fair to say. And the Westpac hasn't had the change at the top that the other three did. And to be fair to Westpac, it didn't have the same deep-seated cultural issues that National
So the
Bank
wealth divisions weren't ripping their customers
and
off.
Comsec. Well, they may have been, but they
Let's
just
call
didn't
a
get.
spade a spade here.
They didn't get caught. Well, you know, at the end of the day, it's not. It takes two to tango, and to be honest, you know, sometimes the customer is at fault as well because they're just plain lazy. You know,
Or they don't read the document.
They don't read the document. There's a massive amount of apathy out there when it comes to money. There's a massive amount of ill advice, not just from professional advisors, but their friends, their families. You know, we can be our own worst enemies. It's not just...
I don't dispute that. I'm in the game, and I shrug my shoulders. But we're coming into interesting times, and the reason I really just very quickly mention the wealth divisions is that, you know, the number of financial planners is dropping significantly.
It is, because to be quite honest, it's a pain in the bottom to do it. It's not very well rewarded. The risks are getting extraordinarily big. Compliance is a bone of everybody's
Through the roof.
The old guys that have been around for a long time, who really aren't qualified in the sense of, you know, the formal qualifications.
Of having the FASEA.
They have 30
quals.
years experience. But, you know, against somebody that's come out of uni and got all the experience in the last 2 years, they fail. So the old guys are saying, you know what, it's just not worth it. Yeah. So we're going to get out of the business, and you're going to be ending up with 25-year-olds with the right qualifications,
but no market experience.
With no experience at all, and they've never even seen the GFC, let alone, you know, the .com, let alone whatever it is. But, you know, all that experience is disappearing because it is just too painful an industry, and the rewards are drying up. And you know, like you could argue they've had it too good for too long. But you know, at the end of the day, that there should be some sort of balance to try and keep the experience in the business, at least for long enough to help the new generation sort of find their feet.
Well, I think there's a lot more to be said in that space, because the Financial Planning Association of Australia are trying to interact a lot, and FASEA, the government body that's overseeing the regulation of the industry, is having difficulty. The tax office is wanting SMSF trustees to have a lot more advice, which they don't necessarily want. The reason they bought an SMSF was so that they didn't have to take advice, and it just keeps going. It just keeps going. One of the themes, and again, that recurring theme, we talk about chasing yield, and we're going to be picking up in the next few weeks, listeners and viewers, is going to be around asset allocation. And again, I think asset allocation is still one of those very, very poorly understood subjects. So, Henry, I'm going to be picking your brain on that a little bit later on in the next few weeks. And again, picking up on some commentary from the last couple of weeks, we've talked a little bit about real estate, but now we're starting to see the commentary and the articles coming out. And again, this one, if I could show the camera, it's highlighted down the bottom there, but it's saying here, house price to increase 30%. And again, I look at this and I want to scream, because no sooner than, what was it, 2 months ago, we were predicting the end of the real estate market as we knew it, but within the space of 2 to 3 months, we're back on boom times again. Yet we're still talking about record levels of debt in this country. So I never know what to believe in that space.
I mean, anybody believes that has not been listening and has got rocks in the head, because house prices can only increase if people can spend more money,
and if they're earning more,
and we know that wages aren't increasing. We also know that banks are not lending anywhere near what they used to. So how can you afford a house price that's gone up 30%? Unless it's a comparative thing. Fine, if your house has gone up 30%, that's great. You can just keep playing that ladder game. But generally, if house prices go to 1.3 million in Sydney as the average price, who's going to be able to afford that? Not normal people.
I have that discussion all the time, believe me, with my 20-something-year-old kids. Let's move on. RBA So we talked last week about the interest rate cut that didn't occur, which we all picked correctly. It's always nice that all the pundits actually get it right. But again, I follow a very good economist out of the AICD, Mark Thirlwell, and his writings this week. He talks about the RBA cash rate being left unchanged at its 5 November meeting. And they're talking now about the central bank thinking that the scenario for the economy to grow at 2.25% this year and then for growth gradually to pick up to 3% by 2021. What are your thoughts on that, Henry?
It's dreaming.
I think so too. I think so too, because hot on the heels of that announcement, we've then got the Treasurer, good old Joshy, announcing that he would make no changes to the current statement on the conduct of monetary policy. Yet, we are just in the last few days, we've seen retail sales figures come out. And what are they telling us, Henry?
I think they're telling us more than the economists would think about. I think they're telling us the world has changed, to be honest. And I don't think we will see... I think we've seen the bottom of interest rates in this country.
You don't think there's another dip yet?
No, why would they? What's the point? The ones so far haven't worked. Retail has changed. Some retail is doing really well, apart from the fact that it's been disrupted massively by online. We've also imported disinflation from China. We all know that's a fact of life now. And I think people have got fed up of buying stuff. People are changing their habits. They either want experiences or they want to recycle and reuse stuff.
So you really think this recycling, reuse,
Yes.
Chaz and the guys at the
big time.
That's actually starting to have impact.
I think this is.
So the big ball of clothes that they had in Martin Place, people are now starting to go, you know what? I might actually wear that pair of jeans for a bit longer now.
Yeah, and you look at the amount of water it takes to produce, cotton.
Cotton, it's astounding, isn't it?
Yeah, and here we are in a country we're going through the massive drought, huge bushfires at the moment. I think people are looking at, you can only put so much stuff in a house, and we've seen it on that telly, that there's a show with the Japanese lady whose name I can't remember off the top of my head, but where you declutter your life.
Yes, I do know who you mean, yes.
And that has become...
I'll look for that name.
That has become a thing. And
it is.
And I think, retailers generally have to accept that the consumer has changed. We live out of our phones, we live out of our laptops. How much more stuff, when you've got your eyes down there anyway, can you look at, can you appreciate? So I think that for the RBA, they will maybe talk a good talk about lower interest rates and stimulating the economy, because they've got nothing else they can do, and the government's decided they're not going to stimulate the economy. But at the end of the day, it's not working. They could go to zero and it wouldn't make any difference at all into retail habits. People would just pay off their debt a little bit sooner. I don't think it's going to change any of the millennial habits. Let's face it, your credit cards still cost you 20%. So if they go to zero, that's not going to change on your credit card.
No, it's not.
And all it will do is it will absolutely emasculate the banks, because their interest rate margins, which at the moment I think their net interest rate margin is around 1.8%. If you go to zero and there's no money from deposits, people will take that money out and go elsewhere, and the banks will have to pay up, and the net interest margin will come down, their profits will come down, and their ability to lend, which makes the world go round, will go down as well. So you could be shooting yourself in the foot. Plus, it sends a message to the consumer, hey, there's something seriously wrong here, guys, when there isn't. We keep getting these messages, the economy's in trouble, and pretty soon you start running around telling your friends, the economy's in trouble. I know it's in trouble because interest rates are coming down. The RBA's cutting rates. We didn't see these rates in the GFC. This is worse than the GFC. Is it really worse than the GFC? I don't think so.
Well, I must say this is something we're going to track, because I like you, December, January, people go to the beach and put sand in their toes and all that kind of palaver, so nothing happens over December, January. But you're saying, your predictor is right now, nothing's going to change interest rate rise. We've hit the bottom?
Yeah.
Okay. I reckon, listeners and viewers, that we're going to go for another 25 basis points either February or March of next year, because when the Christmas sales don't occur, and you rightly say that people are thinking a lot harder about what they're buying, I think there's going to be a certain level of panic, because sooner or later the message is going to get driven home that people aren't making enough money. and nothing's happening, and we're in a very myopic environment, and so they're going to put pressure on the RBA, and so I think I reckon there's room for at least another 25 basis points in February or March.
Okay, so if they do cut again, will that make you increase your spending?
No, absolutely not.
But realistically, I mean, when you start talking to people about a quarter here, a quarter there, will that really change your habits? No, is the answer.
No, but my suggestion is that because other than a tax cut, this government's done nothing from a monetary policy perspective.
Well, they have.
And so
they're chucking money at the bush.
Okay, but that's $2 billion that they've only sorted out in the last 5 days.
Oh yeah.
Okay, so there's got to be flow through from that. And with retail sales, the retailers are going to be bleating in their ears in February when the results come in. I think there'll be one more reaction to that because they need to be seen to be doing something.
But you see, I mean, not all retailers are created equal. JB Hi-Fi is still doing astonishingly well. People, you go into JB Hi-Fi, they are selling stuff like there's no tomorrow.
I bet.
Harvey Norman is still doing extraordinarily well, amazingly enough. If we do get this housing boom continuing, we're going to see stocks like Nick Scali, they will do quite well as well. Kogan is doing very well. It's only the people like Myer and those sorts of guys that are doing badly. Good retailers do well. Bad retailers go out of business.
Okay. So, rounding out our discussions today, I wanted to let the viewers and listeners listen to this about Aramco, because we've talked about Aramco for a bit over the last few weeks. Interestingly, OPEC, the producer group, expects demand for its crude to slide by about 7% over the next 4 years amid a flood of US shale supply. So that's interesting. More interesting though, and again, we wanted to talk about context and how big this beast is. And I'll read directly from this quote from out of Bloomberg. The context of the forthcoming IPO of Saudi Aramco, which made a staggering $111.1 billion in profit last year, more than Apple, Google and ExxonMobil combined. So the estimates for the proper market value are all over the place. And so we've got a $2 trillion valuation being sought for by the Saudi government.
No.
So
not going to happen.
And again, all I'm simply talking about now is context. When you talk about 111 billion in profit, so it's an amazingly big company.
I don't even know how many zeros trillion is.
No, it's just trillion is 12.
Right.
Billion is 9.
Right.
Million is 6.
Right.
I dreamed that. I think I'm not so sure. Who knows? Okay, so
Sounded
to round out. Hits and misses. What are the hits for the week? We've talked about a few of them, Zip and Xero. Any others that really caught your eye in the last week?
Well, last week was all about the banks, all about National Bank's results, which were on Thursday. The reaction to that, and I think we have, the market is trying to go higher. It's trying to grind higher, which is good. But this week will be interesting because it'll be back to trade talks, and in theory, 15th, 16th is when Mr. Trump and Mr. Xi are going to meet and talk, but that's not going to happen. So it will be December. So it'll be the Sunday tweets from Donald, which will be the focus this week.
See what happens. And any misses?
I think the market is getting itself into a very positive mood for the run up to Christmas, and there could be some disappointment. So I think you just have to be a little bit careful. US markets all-time highs again. But it's getting a bit stretched, a bit toppy.
Okay. Henry, thanks so kindly for your time and your views this week. Viewers, listeners, don't forget our socials, our contacts and feedback, always welcome. And for the week ending, commencing 11th of November, thanks so kindly for listening in. Have a great day.